why you should learn market physics and not pattern trading. That's the topic of today's video. Hi, this is Load with Black Bear Dog Trading, and as always, welcome. So, what is market physics to begin with, and why is it so important to your long-term and overall trading success, as opposed to learning how to trade patterns based on candlestick formation? Well, patterns like head and shoulder, top, bottom, shooting star, whatever you have out there, is not how markets operate. Markets operate with cycles, volatility cycles, tick flows, liquidity regimes, energy thresholds, and that's what really decides. Let me turn off my phone here. Sorry about that. Give me a quick second. I'm in a trade. That's why you hear it go zing, zing, zing. There we go. So we don't get disturbed again. Market physics, as I was explaining, is what turns actual trading into algorithms that are mathematically justified. Patterns like engulfing, long bullish engulfing, bearish engulfing, head and shoulder, top and bottom. I mean, those are really what I like to call cartoon patterns, and it's cartoon trading because it's visual. But again, this is not how markets operate. Markets operate by volatility, momentum, by tick flow, by liquidity regimes, by energy thresholds, which is like news that comes all of a sudden and pushes the market through the roof, or reverse opposite. And it's really to your benefit, even as a retail trader, that you learn how to trade in such a way. It's called market physics, as opposed to pattern trading. Don't let the name scare you. It is not as difficult as it sounds. And in fact, by the time I'm done with this video, you'll have a clear take on the beginning part of markets physics. In fact, if you watched my prior video and you downloaded the little spread control tool that I made available over there, then you already have one portion, a very intricate portion of market physics, which is that you never ever enter a trade when a spread is just ridiculously high. You set a limit to your spread and you abide by that limit. And if the spread, especially around opening time or during transition from New York to Asian markets, spreads tend to get a little bit rough, to say the least. You don't want to be in a position like that. I mean, it costs you too much just to enter a trade. You're basically fighting a losing battle. So that's already one part, but there is more that you could do. And the next thing you can do is load up an ATR. ATR stands for average true range, and it's not a signal indicator. It's not a direction indicator. It is merely a market physics that tells you where price has been over the course of a certain period, and where price then more than likely will continue to be over X period to come. History repeats itself, and even in markets, history repeats itself. So an ATR can give you very valuable insight as to whether or not you should take a trade. And combined with spread control, you already are way ahead of most retail traders who are absolutely stuck on pattern trading. So an ATR, as it normally is, let me load one up on the chart. I'll get myself out of the way here, and over there somehow. No, that's too big. I'll make myself a little smaller maybe. Okay. This program that I'm using, I really don't know exactly how to use it, but bear with me. So I'm going here and I'll load the default ATR on here, and it's set to period 14, which is what we accept. Click on OK, and here you go. This is the default ATR. It tells you right now it's at 0.00102. Nobody knows really what that means. I certainly don't, and I've been trading for more than 15 years. It shows me an up here. I have no clue what that point right here, the last point right here, means in conjunction to those two levels. So this is the standard ATR. It's really not very useful, yet it is absolutely a market determined whether or not you should take a trade. So what I've done, I'll get rid of this thing here because it's actually kind of annoying. Let me see how I can do this. There we go. Delete. So what I've done, I've built my own custom ADR, and that is what you see right here. And it's very easy to read. It's very simple to understand. There's a dead zone, a quiet zone, a normal zone, a strong zone, and there's actually even an extreme zone on top of that, which only pops up if ATR actually goes in the extreme zone. So how does this work? It's really simple. It follows the exact same calculations as the default ATR, but it gives you bands so you can tell easily where the market is in the dead zone or the quiet zone. Don't trade. The market is just dead. There's nothing happening. You should always look for the ATR to be either in normal or in strong position. And it gives you a percentage right here. At present, the ATR is at 8.65, and it's N for normal, but we're right at the edge of normal and strong. This is definitely a very positive market physics that will tell you, hey, maybe you ought to consider to actually get into a trade because the ATR is very strong. Volume is up, volume is increasing, momentum is strong. At the same time, you look at the little spread utility that I gave you, and it'll show you whether or not the spread is within the parameter that you want it to be. I actually have a modified version of the one that I let you download right here, and it says my maximum spread is set to 2, and right now the spread is at 1.7. So just alone on those two market physics right here, I am in a good position to enter a trade. Of course, there is more to it, and as we get along in our training here, you will learn more about markets physics, other little components that are really not difficult. It's just a matter of you learning how to do this. So now, how exactly do you know that 8.65 is good and whatever the other levels may be is not so good? How do you determine that, and where is that coming from? Well, I created a booklet that actually explains that, and you can download that booklet. It's in the link below, in the description box below, and I'll show you exactly what that is. Right here we go. It's called the normal ATR percentage range for the Euro USD on a 15-minute chart. These are ranges that you see 90% of the time on websites provided by healthy brokers. And here we go. Let's have a look at it. A debt market is anywhere from 0.5% to 4%, and it tells you exactly drift, Asia, rollover, no energy. Drifting means that the market is just drifting. Quiet but tradable, 4.0 to 6.0%. It's slow. It's a slow grind. The bars are moving, but not really. Low energy. Normal volatility, 6.0 to 10.0. London and New York, as well as an overlap. High volatility is above 10, all the way up to 15. It's very trendy days, most likely driven by news expansion. And then there is extreme, which, as I already said earlier, is only visible if we actually reach that level. And that's major major news breaks, and even panic moves. They scared the bejeebies out of us, and now everybody is selling or everybody is buying. That would be a panic move. So as you can see very clearly, the right here, the normal volatility 6 and up is where you should start looking at um, at whether or not this might be a viable entry position. So this is based on information and detailed analysis of years of studying the Euro-USD behavior and ATR math, which by now has become the uniform standard worldwide. This analysis was not conducted by me. It was conducted by global financial institutions, hedge funds, investment firms, and banks. So, in other words, this is solid stuff because these companies, they rely on this being accurate. So, after all, their pot of gold is of utmost importance to them. It's important to all of us traders, but it's particularly important to them. So, in short, this is what you get. If it's below 4%, the market is dead, don't bother. If you're anywhere 6 and above, start looking into possibly see if the rest of the conditions are good to enter a trade. If you're 10 to 15, heck yeah, you're sitting in a strong move. And if you're in 15, my goodness, it's explosive. Warning, when you're in the 15, do not jump saying to yourself, oh wow, this is now I'm guaranteed to win. Be careful. Those explosive ones tend to also reverse rather rapidly. So the best two levels are normal and strong. It's buyer beware. So how do you get all this and what is the range for this? And by the way, why does this make sense? I want to get into that. You can download this book. You'll get all this information, but I just want to go over it. It tells you exactly why these ranges make sense in the Euro-USD. It's the most liquid pair in Forex trading. It's subject to mean reverting. It has low volatility, tight spread, so forth, so forth, so forth. And it even tells you the ATR percentage rarely goes above 10 unless something really major is happening. And now the question is, how do you calculate this? How do you implement this? Well, the formula is right here, and it's very simple. It's the value of ATR times the current price. You divide that by 100. For example, my ATR is at 0.00080, and I've taken that from the original ATR indicator. My price at that time is 1.08500. I took that from the chart. I divide the ATR value by the price value times 100, and that gives me this number right here. Problem is that number is not understandable or readable on a chart, so the large companies have come up with an enhancement of the formula to convert this to pips per unit, and that is based on a number of 10,000, and I explain exactly why the 10,000. This is not a number just taken out of thin air and sounds good, let's use that. There's a reason behind the madness. And then when you apply the formula, now you get something you understand, 7.37%. You take 7.37%, you line that up with our little chart that we have right here, and you know I'm in the normal zone. I should look at the market, whether or not I may have possibly a trade. I also compare it to my spread. I'm sitting good, I'm sitting below my maximum allocated spread. Okay, let's see, maybe I may have a trade. So that is what this does. Now, of course, you need to calculate this for every single trade that you do. You got to check this, make sure it's accurate, make sure that you don't just jump and because it was good for one trade, it doesn't stay that way. As you well know, markets constantly fluctuate up, down, left, right. I mean, meaning sideways, right? So, you know, it's up to you to calculate this every time. I'll be the first to tell you that's a pain in the tush, to say it mildly. So, what can you do instead? Well, as I already mentioned earlier, I have this custom-made ATR right here that automatically does this for you. And you can have it with the bands, so it's a clear visual, or if you click on hide the bands, then you have the standard ATR, but with the added percentage to it that is not available on the full ATR that comes with your trading platform. So this tool is also available to you free of charge. You can download it also, link is below, and just load it up on your charts, and together with the spread right here, And this, you now already have two market physics that are very strong indicators of whether or not the market is tradable at the moment. And it's really that simple. By the way, I just want to show you this little indicator. There is very little to set up. It's only if you want to have the ATR period, which is the default of 14, I suggest you leave it. And it has take it on closed bars or on live bars. Live bars means that this percentage right here is calculated directly on the last point of the ATR line. It's set to false, meaning that this is calculated on the last closed bar, which is the bar that officially closed just before a new bar started. Why you want to leave it at closed bars? Well, I've been saying it now for a long time. You cannot make trading analysis on a live bar. It's really that simple. A live bar bounces up and down, and you really are not in a position to make a solid decision. You're just not. The bar, how can you? It's like a roller coaster. It just goes, there is no way. Closed bars, on the other end, the information has been locked in. It can no longer change. The high stays as it is, the low stays as it is, the open stays where it was, the low stays where it was. Nothing can change. It's locked in information, and you really, as a trader, should get in the habit of starting to do your analysis and trading on closed bars. That, by the way, is the third market physics. Now you already know that as well. Start doing your analysis on closed bars. Forget a live bar. A live bar is exciting because it dobs up and down and it makes you feel alive because there's movement happening. Don't get caught in the trap. It's the primary reason why you are not making it as a retail trader, because you're focused on the wrong items. It's also another reason why you don't make it as a retail trader, because pattern trading, which again I call cartoon trading, has been proven time and again that it does not work. Now, in my little PDF file that you can download, I explain why pattern trading is what most retail traders learn, and why brokers push that through, and why all the available trading courses that you find online are all based on that. And you find the explanation for that also in the PDF. Anyway, I've went on long enough. This is it for today. So download the tools. They're very beneficial to you, free of charge as always. And as always, take care and God bless.